In March 2020, the world didn't just panic buy toilet paper. It panic sold everything. Stocks, bonds, oil, airlines, hotels, even gold. Markets weren't falling. They were falling down the stairs. In just 33 days, the global stock market lost over $30 trillion. That's not a typo. That's the fastest financial crash in history. And here's the weird part. The economy didn't collapse because companies were bad, or banks were crooked, or investors were stupid. It collapsed because the world hit pause. And the system? It was never built for that. Let's make this stupidly simple. Money moves because people move. They work, they travel, they buy things, they borrow, they repay. COVID shut all of that down. Planes stopped flying, offices emptied, factories froze, ports clogged. Supply chains snapped like cheap rubber band. And suddenly, the global economy did something it had never practiced. Nothing. No movement, no spending, no certainty. Markets hate many things, but they hate uncertainty the most. So investors did the only thing they knew how to do. They ran.
Get out of here!
Here's what most people don't realize. The 2020 crash wasn't caused by fear alone. It was caused by leverage. Leverage is borrowing money to make more money. It works great until it doesn't. Hedge funds, banks, corporations, they were all stacked with debt. So when prices started falling, margin calls kicked in. That's Wall Street for, pay us now or we sell your stuff. So assets were dumped, which pushed prices lower, which triggered more margin calls, which forced more selling. It wasn't a crash. It was a chain reaction. And it happened at internet speed. March 12, 2020. Stocks plunge, then plunge again, then trading halt. 4 times in 10 days. Even the bond market froze. That's bad. Because bonds are supposed to be boring. If bonds panic, the adults are screaming too. Companies couldn't roll over debt, banks stopped lending, cash disappeared. This wasn't the stock market is sad. This was, the plumbing of the financial system is clogging. And when plumbing fails, things get messy. When markets break, governments have 2 choices. Option 1. Do nothing, watch the system collapse, hope society survives. Option 2. Print. Fast. A lot. They chose option 2. Within days, central banks around the world hit the panic button so hard it dented the table. The U.S. Federal Reserve cut interest rates to 0. Again. In a single emergency meeting. Then they did something bigger. They promised to buy anything. Government bonds, corporate bonds, mortgage bonds, ETF, even junk debt. If it looked like money, the Fed was interested. Contrary to popular belief, they didn't fire up a literal printer. They did something cleaner. They created digital money out of nothing. With a few keystrokes, the central bank credited banks with trillions of dollars. No tax hike, no vote, no waiting. Just money. Between 2020 and 2021, the US created about 40% of all dollars ever made. Read that again. Almost half of every dollar in existence was born in a 2-year panic. Other countries followed. Europe, Japan, the UK, China. Everyone printed. Because nobody wanted to be the only one who didn't. Then came stimulus. Governments sent checks straight to people. Stay home, don't work, here's money. In the US, some households received more income not working than they did working. Businesses got bailouts, loans that turned into grants, payroll support. Airlines were rescued, banks were protected, markets were reassured. The message was clear. We will not let this system fail. And markets listened. Here's where things get weird. The economy was collapsing. Unemployment exploded. Small businesses died. Entire industries shut down. And yet the stock market bottomed in March 2020 and started going up. Fast. By August, tech stocks were partying. By November, everything was rallying. By 2021, markets were hitting all-time highs. People were unemployed, but stocks were thriving. Why? Because markets weren't reacting to reality. They were reacting to liquidity. Money was everywhere, and money always has to go somewhere. This is the uncomfortable truth. The crash revealed what the system is really designed to protect. Not workers, not small businesses, not stability. It protects asset prices, because assets are owned by the people who matter. When things break, the system doesn't ask who needs help. It asks what must not fall? And in 2020, the answer was clear. When governments create money fast, they like to say it's temporary. Emergency only, one-time support, nothing to worry about. And at first, it looked like they were right. Inflation stayed low in 2020, then 2021. Everyone relaxed. Turns out, inflation doesn't arrive with a bang. It shows up late, quiet, uninvited, because inflation isn't about printing money. It's about spending it. And once lockdowns ended, people spent hard. Here was the problem. Money was everywhere, but stuff wasn't. Factories were still broken, shipping was chaos, workers were missing, ports were jammed. So you had more cash chasing fewer goods. That's inflation in its purest form. Cars got expensive, rent jumped, food prices climbed, energy exploded. By 2022, inflation hit levels not seen in decades. And suddenly, the phrase temporary disappeared from press conferences. Now central banks had a new problem. They caused inflation. And inflation makes people angry. So they did the only thing they know how to do. They reversed. Interest rates went up. Fast. Aggressively. The same system that was flooded with cheap money was suddenly starved. Borrowing got expensive, mortgages spiked, stocks wobbled, crypto imploded. Companies that survived COVID on free money started collapsing without it. 2020 was the sugar rush. 2022 was the crash. Here's the part no one likes to say out loud. The people who benefited most from the money flood were the people who already owned assets. Stocks recovered, real estate soared, wealth grew at the top. The people who paid the price were everyone else. Renters, savers, wage workers. Their money bought less, their costs rose, their savings quietly shrank. Inflation isn't random. It's a tax. And it's one that hits hardest when you don't own assets. The COVID crash wasn't just a pandemic story. It was a stress test, and the system failed it. It showed us that markets don't reflect reality. They reflect policy. It showed us that crashes don't get solved. They get postponed. And it showed us something even more uncomfortable. When everything breaks, the rules change. Fast. For some people, the COVID crash wasn't the worst crash in history. It was the fastest. And it won't be the last. Because the conditions that caused it are still here. High debt, cheap money, fragile supply chains, and a system addicted to intervention. The only difference next time is the panic will come sooner. And the bill? It'll be bigger. After every crisis, you hear the same phrase. No one could have seen this coming. COVID was a black swan. Unpredictable. Unavoidable. That sounds comforting. It's also wrong. The virus was unpredictable. The financial collapse wasn't. Because the system wasn't fragile by accident. It was built that way. For decades, the global economy chased one thing: efficiency. Just-in-time supply chains, minimal inventory, maximum leverage, debt instead of buffers. It worked beautifully in calm times. But efficiency removes slack. And slack is what saves you when something goes wrong. So when the world stopped moving, the system had no cushion. No backups, no room to breathe. Everything snapped at once. Here's the uncomfortable truth. The global financial system can't stop. It can slow down, it can wobble, but it can't pause. Because debt doesn't pause, interest doesn't pause, rent doesn't pause. So when COVID forced the real world to stop, finance had to keep going. And the only way to do that was to replace real activity with fake liquidity. Printed money stood in for real production. For a while that worked. Every crisis looks different on the surface. 1929 was speculation, 2008 was housing, 2020 was a virus. But underneath, they rhyme. High leverage, overconfidence, centralized risk, and the belief that someone will step in. They always do. Which quietly teaches the system a dangerous lesson. Don't worry, take more risk, the safety net will catch you. Until one day it can't. The sketchy part isn't that governments intervened. They had to. The sketchy part is what happens after. The incentives don't change, the debt stays, the system resets and loads more risk on top. Each rescue makes the next crisis larger. Each bailout raises the floor and the ceiling. So when people ask, was COVID a one-off? The honest answer is no. It was a preview. If this made sense, subscribe. We'll keep it simple. The COVID crash taught us something simple. The system doesn't break when things go wrong. It breaks when things stop. And the more we build a world that can't pause, the more violent the next pause will be.